There are at least 7 different ways to own silver. Most people only know about 1 or 2. And here's the problem. Choosing the wrong form of silver ownership for your situation could cost you thousands of dollars. Or worse, you might not actually own what you think you own. Let me give you an example. If you buy silver through certain ETFs, you don't own silver. You own shares in a trust that owns silver. And in some cases, that trust holds paper claims on silver that may or may not exist in physical form. If something goes wrong, a financial crisis, a market disruption, a counterparty failure, you might discover that your silver was never really yours. That's not fear-mongering. That's reading the fine print. So today, I'm going to break down every form of silver ownership: physical coins and bars, ETFs, mining stocks, futures contracts, allocated accounts, unallocated accounts, digital silver tokens. For each one, I'll explain what it actually is, the real pros and cons, who it's best for, and the risks nobody talks about. By the end of this video, you'll know exactly which forms of silver ownership match your goals, and which ones to avoid. I'm the Stack Guy. Let's make you dangerous. Before we dive into each type, let me give you a framework for evaluating any form of silver ownership. I call it the ownership reality test. 4 questions. Question 1, do you have direct claim to specific metal? Is there a specific bar or coin with your name on it? Or do you have a claim on a pool of metal that many people share? Question 2, is there counterparty risk? If the company, bank, or exchange that holds your silver goes bankrupt, do you still have your silver? Or does your claim become worthless? Question 3, can you take physical delivery? If you wanted to hold the metal in your hands tomorrow, could you? What would it cost? How long would it take? Question 4, what are the real costs? Not just the purchase price, storage fees, management fees, spreads, premiums, tax implications, total cost of ownership over 5 years. Every form of silver ownership answers these questions differently, and those differences matter enormously depending on your goals. Okay, let's go through each type. The first and most straightforward form, physical silver that you hold yourself. This includes government minted coins like American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. It also includes privately minted rounds and bars from companies like Sunshine Mint, Pamp Suisse, or generic manufacturers. How it works. You buy silver from a dealer, online or local. They ship it to you or you pick it up. You store it yourself, at home in a safe, in a private vault you rent. You hold it, you control it, it's yours. Ownership reality. Test, direct claim to specific metal. Yes, you're literally holding it. Counterparty risk, minimal. If your dealer goes bankrupt after you've received your metal, you still have your metal. Can you take physical delivery? You already have it. Real costs? This is where it gets complex. The costs of physical silver include premiums over spot. You don't pay spot price, you pay spot plus a premium. For Silver Eagles, that premium might be $3 over spot. For generic rounds, maybe 1 to 2. For large bars, lower premiums but higher total outlay, shipping and insurance. If buying online, you're paying for secure shipping. Usually $5.15 per order, sometimes more. Storage costs. If you use a home safe, that's a one-time cost. If you rent a bank safe, deposit box, or private vault, that's ongoing. Spread on resale. When you sell, dealers pay you spot minus a discount. So you lose on the buy and the sell. This spread can be 5 to 15% total. Pros. No counterparty risk. If the financial system collapses, you still have metal. Complete privacy, depending on your jurisdiction and purchase method. Tangible. Psychological value of actually holding wealth. No ongoing management fees. Cons. High premiums. Compared to paper silver, storage and security burden falls on you. Liquidity can be slower. You need to find a buyer. Theft risk if stored at home. Large positions become physically cumbersome. Best for long-term holders focused on wealth preservation. People concerned about financial system risk. Those who want zero counterparty risk. Smaller positions where premiums are less impactful. The risk nobody talks about. Physical silver is only as secure as your storage solution. Every year, stackers lose silver to home theft. And if you're the only one who knows where it is, what happens to your family if something happens to you? Document your holdings. Have a plan. Security matters. The second form, exchange-traded funds that track silver prices. The biggest examples are SLV, iShares Silver Trust, and SIVR, Aberdeen Standard Physical Silver Shares. There are others, but these dominate. How it works. You buy shares through your brokerage account, just like buying stock. Each share represents a fractional claim on silver held by the trust. As silver prices move, share prices move. You don't hold physical silver. You hold shares in a fund that holds silver. Ownership. Reality? Test. Direct claim to specific metal? No. You own shares in a trust. The trust owns silver. You have indirect ownership. Counterparty risk? Yes, multiple layers. You're trusting the brokerage holds your shares correctly. You're trusting the ETF sponsor manages the fund properly. You're trusting the custodian actually has the silver they claim. If any of these entities fail, your claim becomes complicated. Can you take physical delivery? Technically, yes. Practically, no. SLV's prospectus allows redemption for physical silver, but only in baskets of 50,000 shares. At current prices, that's over $1.5 million minimum, and you'd need to be an authorized participant, major financial institution, to do it. For normal investors, you cannot take delivery. You can only sell shares. Real costs? Lower than physical, but not zero. SLV charges 0.50% annual expense ratio. SIVR charges 0.30%. These fees are deducted from the fund's silver holdings, so your claim slowly shrinks over time. No premiums on purchase, no shipping, no storage burden. But you pay commissions, though many brokers now offer commission-free trades, and you face the bid-ask spread when buying and selling. Pros: very low barrier to entry, by any dollar amount. Easy to trade, buy and sell in seconds. No storage burden. Lower total cost for short-term holdings. Tax-advantaged accounts can hold ETFs. Cons: counterparty risk at multiple levels. Cannot take practical delivery. Annual fees erode holdings over time. In a severe financial crisis, ETF structure could face stress. You don't own silver, you own shares in something that owns silver. Best for short to medium-term traders. Those who want silver exposure in retirement accounts. Investors prioritizing liquidity and convenience. Those who trust the financial system to function normally. The risk nobody talks about. Read the prospectus. Seriously. SLV's prospectus contains language about force majeure events where the fund can suspend redemptions. It contains disclaimers about the custodian's ability to verify sub-custodian holdings. It acknowledges that physical audits are limited. This isn't conspiracy, it's in the legal documents. Most investors never read them. Does this mean SLV is a fraud? No. It means you should understand what you're buying. You're buying convenience and accepting counterparty risk. The third form, trusts with stronger physical backing and redemption options. The main example is PSLV, Sprott Physical Silver Trust. How it works. Like an ETF, you buy shares through your brokerage. Each share represents silver held by the trust. But there are key structural differences from SLV. PSLV is a closed-end fund, not an ETF. It holds fully allocated, audited silver bars stored at the Royal Canadian Mint. And crucially, individual investors can redeem for physical delivery. Ownership reality. Test, direct claim to specific metal. Closer than ETFs. The silver is allocated, meaning specific bars are assigned to the trust. Monthly audits verify holdings. Counterparty risk, lower than ETFs, but still present. You're trusting Sprott, the sponsor, the Royal Canadian Mint, custodian, and your brokerage. Fewer layers than SLV, with a more credible custodian. Can you take physical delivery? Yes, with minimums. PSLV allows redemption for physical silver, starting at approximately 10,000 ounces. That's around $300,000 at current prices. High, but accessible to serious investors. Much lower threshold than SLV's 50,000 share baskets. Real costs? PSLV charges 0.62% annual expense ratio, slightly higher than SLV, but the additional cost buys stronger physical backing and redemption rights. PSLV often trades at a premium or discount to its net asset value, NAV. Right now, check the current premium discount before buying. Sometimes you're paying more than the silver is worth, sometimes less. Pros? Stronger physical backing than ETFs, actual redemption rights with minimums, credible government mint as custodian, monthly third-party audits, can hold in retirement accounts. Cons: higher expense ratio than SLV. Premium discount to NAV adds complexity. Redemption minimum still high for most investors. Still counterparty risk, less but present. Closed-end structure can create price dislocations. Best for investors who want paper convenience with stronger physical backing. Those planning large positions who might eventually redeem. Retirement account holders who want better than ETF exposure. Stackers who accept some counterparty risk for convenience. The risk nobody talks about. PSLV trades on exchanges. In a market panic, its price can disconnect from NAV. In March 2020, PSLV traded at a significant discount, meaning you could buy shares representing more silver than the share price implied. Good for buyers in that moment. Stressful for holders who saw their account value drop more than silver prices. The share price and the silver value aren't always the same thing. The fourth form, shares in companies that mine silver. Examples include First Majestic Silver, Pan American Silver, Hecla Mining, and dozens of others ranging from major producers to junior explorers. How it works. You buy shares in a company that extracts silver from the ground. If silver prices rise and the company operates well, the stock should rise, often by more than silver itself. This is called leverage to the silver price. Ownership reality. Test direct claim to specific metal? No. You own part of a business. That business produces silver, but you don't own the silver directly. Counterparty risk? Significant. Mining companies can go bankrupt. They can have operational disasters. They can be mismanaged. They can have reserves that don't pan out. They can be nationalized by governments. Your shares can go to zero, even if silver prices rise. Can you take physical delivery? No. You own shares, not metal. Real costs? Brokerage commissions? Often zero now. No expense ratios like funds, but mining companies themselves have costs. Debt, operations, exploration, that affect your returns. Pros? Leverage to silver prices. If silver rises 50%, a mining stock might rise 100, 200%. Dividend potential from profitable miners. No storage concerns. Can hold in any brokerage or retirement account. Upside potential beyond silver price alone. Cons. High risk. Mining is a tough business. Company-specific risks unrelated to silver prices. Requires research and due diligence. Can lose money even when silver rises. Volatility much higher than silver itself. Best for speculators seeking leveraged exposure. Investors who understand mining business fundamentals. Those willing to do company-specific research. People seeking potential multi-bagger returns. The risk nobody talks about. Most silver mining stocks are not pure silver plays. They produce gold, zinc, lead, copper alongside silver. A silver miner might get only 30-40% of revenue from silver. If you want pure silver exposure, mining stocks are an imprecise tool. You're betting on management, operations, and other metals as much as silver. Also, from 2011 to 2015, silver dropped about 70%. Many mining stocks dropped 90% plus. Leverage works both ways. Spectacular gains are possible. So are devastating losses. The fifth form, derivative contracts on COMEX. If you watched my COMEX video, you understand what futures are. Contracts that give you the right to buy or sell silver at a set price on a set date. How it works. You open a futures account with a broker. You put up margin, a fraction of the contract value. You buy or sell contracts representing 5,000 ounces each. You profit or lose based on price movement. Most contracts are closed before delivery. You're betting on price, not taking metal. Ownership reality. Test, direct claim to specific metal? No. You have a contract, paper claim. Counterparty risk? Yes. Broker risk? Exchange risk. Clearinghouse risk. Can you take physical delivery? Technically, yes. Stand for delivery and you'll get silver, but this requires full payment, logistical arrangements, and is rare for retail traders. Real costs? Margin requirements mean leverage. You control large value with small capital. But this amplifies losses too. Commissions per contract, fees, on the psychological cost of watching highly volatile positions. Pros? Maximum capital efficiency. Control 5,000 ounces with fraction of value. Can profit from falling prices, short selling. Most liquid silver market. Professional trading tool. Cons? Extremely risky. Leverage can wipe out your account. Requires sophisticated knowledge. Not suitable for long-term holding. Contracts expire. Margin calls can force liquidation at worst times. Definitely not for beginners. Best for professional traders and speculators. Hedgers with commercial silver exposure. Those with significant trading experience. Hey, nobody else. Seriously. The risk nobody talks about. Most retail futures traders lose money. This is documented. The leverage that creates big wins also creates big losses. If silver moves against you quickly, you can lose more than you invested. This is a professional tool. If you're watching YouTube videos to learn about silver, you probably shouldn't be trading futures. The sixth form, bank metal accounts where you don't own specific bars. Some banks offer silver accounts where you can deposit money and hold a silver balance. How it works. You deposit cash. The bank credits you with silver ounces at that day's price. You can sell anytime and receive cash. Some banks allow you to convert to physical for a fee. Ownership reality test, direct claim to specific metal? No. You're an unsecured creditor of the bank. They owe you silver. You don't own specific silver. Counterparty risk? Yes, full bank risk. If the bank fails, you're in line with other creditors. Your silver is a claim, not property. Can you take physical delivery? Sometimes, with fees and delays. Real costs? Often low or zero fees for holding, but the spread on buying and selling can be significant. And conversion to physical carries costs. Pros? Convenient. Managed through bank account. Easy entry and exit. Low minimums. Feels like owning silver without the hassle. Cons? You do not own silver. You have a claim. Full counterparty risk to the bank. Legally, your claim may be subordinate in bankruptcy. Not a safe haven in financial crisis, exactly when you want silver. Best for almost nobody, honestly. If you understand the counterparty risk and want convenience for short-term exposure, maybe. But for most purposes, an ETF is better for paper exposure. Physical is better for real exposure. The risk nobody talks about. In a banking crisis, unallocated metal accounts are particularly vulnerable. The bank doesn't have to hold silver equal to all claims. If many people demand delivery simultaneously, there may not be enough metal. Your claim becomes a bankruptcy claim. This is the worst of both worlds. You pay metal prices, but hold bank risk. Let me give you a simple decision framework. If your primary goal is wealth preservation and crisis insurance, physical silver that you hold. Accept the premiums and storage burden. Eliminate counterparty risk. If your primary goal is convenient investment exposure, PSLV for stronger backing, or SLV to SIVR if you prioritize low fees, understand you're accepting counterparty risk. If your primary goal is leveraged speculation, mining stocks if you'll do the research, futures only if you're a professional trader. If your primary goal is tax-advantaged retirement exposure, ETFs or PSLV in your IRA or 401k. There's no single right answer. There's only the right answer for your goals, your risk tolerance, and your understanding of what you're buying. The mistake is not knowing which category you're in, treating paper silver like physical silver, assuming you own metal when you own a claim. Now you know the difference. Choose accordingly. Let me leave you with my personal approach. I hold physical silver, coins and bars that I store securely. That's my long-term wealth preservation position. Zero counterparty risk. I accept the premiums and storage burden. For smaller tactical positions, I use PSLV and brokerage accounts. I accept some counterparty risk for the convenience. I don't trade futures. I don't hold unallocated accounts. I'm selective with mining stocks. Your approach should match your goals, not mine, not anyone else's. But now you understand the options. You can make an informed choice. I'm adding to my prediction tracker. By the end of 2025, at least one major financial institution will face stress that makes their silver product holders nervous. Banks, ETFs, something. It happens periodically. When it does, people holding physical sleep better than people holding claims. That's my view. The tracker will show if I'm right. I'm the stat guy. Next video. The manipulation question. What's proven, what's plausible, and what's faith? Subscribe if you want silver education without the hype. See you then.